Dear participants, welcome back to the last chapter of the first module, Facts and Figures about Sustainable Investing. In the last chapter, we have started to elaborate the connection between finance and sustainability. Every day, we experience how sustainability is transforming the way we live. But what is the impact on the way our savings and pensions are invested? In the last chapter of the first module, we will deal with an introductory lecture on the world of sustainable finance. After completion of this chapter, you will be able to outline the goals of sustainable investing, you will be able to describe the most important investment strategies, discuss the sustainable market development, and you will be able to outline the trends in sustainable investing. Investing in a greener planet and more equitable society sounds good on paper, but what does it mean in practice? The concepts of sustainability and sustainable investment have not been clearly defined and are therefore open to interpretation by investors and issuers alike. Although the EU is endeavoring to specify uniform requirements with its taxonomy, a classification system for sustainable economic activities, there is at present no framework at the global, European, or national level which would allow sustainable investment of capital to be uniformly and clearly categorized and hence quantified. The broadest concept is that of socially responsible investment. It typically encompasses the assets of all investors who have publicly committed to considering sustainability factors, incorporates environmental aspects only. Thus, unlike responsible investment, sustainable investment is based on specific requirements and hence, where possible, on a harmonized understanding of suitable criteria. Yet choosing which benchmark to use is just as complicated as formulating appropriate minimum requirements for a security or its issuer with regards to their contribution towards achieving sustainability goals. This problem mainly affects the debt market, because when checking if bonds are sustainable or green financial products, it always comes down to the use of the proceeds, which means that the sustainability of the finance project has to be measurable. Where environmental, social, and governance, the so-called ESG criteria, are factored into the individual investment decision, meaning that specific requirements are formulated at the security or portfolio level, this is referred to as sustainable finance or investment. Sustainable finance is not confined to climate and environmental protection issues, but also encompasses social aspects and questions about the composition and quality of management at firms in which investments have been or will be made. In the last 1.5 decades, investments in enterprises, organizations, and funds that seek to create both financial returns and measurable social and/or environmental impact have gained popularity. Such investments are called impact investments. Investors who seek financial gains and impact refer to this as the double bottom line, mimicking an accounting term to express how both aspects need to be measured and reported. Impact investments are most commonly made through closed-end private equity and venture capital funds, with debt funds gaining popularity more recently among impact investors. We know now that sustainable investing is not a new asset class. Sustainable investing is a way of judging the investments you'd like to add to your portfolio. Asset classes are essentially types of investments, such as public equity investments, fixed income, and real estate. For instance, based on its ESG rating, impact report, and employee satisfaction, you can decide whether or not you think a particular stock is sustainable. Investors interested in investing sustainably are confronted with 7 main investment strategies. Negative screening, which can relate to individual firms as well as to entire sectors or countries, is not just the oldest, but also the most widely used sustainable investment strategy today. One reason for this is that exclusions can be applied with relative ease and can be tailored according to individual needs. Even so, the exclusion of a specific firm from the investment universe is often grounded in extensive analysis. A less onerous form of negative screening is norms-based screening, whereby all enterprises that do not uphold or support a certain international norm and standard are excluded from the investment universe. By contrast, positive screening explicitly includes companies in the investment universe. A widely used strategy in this approach is the best-in-class strategy, where the first step is to evaluate all companies in the theoretical investment universe, the benchmark, such as a global stock index, using predefined ESG criteria. With thematic investing, on the other hand, investors, especially in the private equity segment, specifically seek out sectors or issues so as to support companies in certain sectors, such as solar technology or sustainable agriculture, and to profit from positive anticipated market developments in the chosen area. The focus can also be broader, however, and include renewable energy in general or support reaching a specific development goal, such as access to water. Another approach related to thematic investing is impact investing. Here, however, the intention is to generate social or ecological value added alongside the usual return, giving rise to a double dividend, for example, both on the financial and moral side. Probably the most comprehensive sustainability strategy is what is known as ESG integration. In contrast to the approaches discussed so far, it is not simply an additional component alongside conventional financial analysis, but forms an integral part of it. ESG criteria and associated opportunities and risks are explicitly and systematically integrated into the analysis of a security's risk-return profile. This means, for example, that drops in revenue stemming from reputational risk or production sites threatened by extreme weather events can be incorporated into investment analysis, allowing for a better assessment of the medium-term financial stability of the analyzed company. In addition, institutional investors, in particular, frequently engage with companies through active ownership, both informally and by exercising their former rights as shareholders. This approach is referred to as engagement. Shareholders seek dialogue with decision-makers at the company in which they have invested and thereby attempt to embed integration of ESG aspects within the company. They also influence policy using their votes and proposals at annual general meetings. If an investor owns a large enough share in a company, they can also participate in the company's decision directly and give sustainability aspects greater prominence on the agenda by taking a seat on the supervisory board. The sustainable investment strategies given as examples here are not mutually exclusive. Many investors combine several of these approaches in order to give their influence on corporate sustainability the greatest possible impact. Negative screening is often paired with a best-in-class strategy, for instance. The engagement approach is also well suited to complement a best-in-class strategy, creating even stronger incentives to integrate ESG criteria. While passive approaches, due to their simpler and more immediate application, were the first to quickly gain volume in the market, in line with increasing public ESG sentiment, since 2015, investors' preference has started to shift to more active ESG approaches, while investments in exclusion and negative screening approaches have declined. Many different initiatives and forums around the globe promote the integration of environmental, social, and governance criteria into conventional finance. In addition, different organizations adopt different strategies or criteria through which SRIs are defined and selected or excluded from the investment portfolios. At least 5 organizations are categorizing sustainable investment strategies: the European Fund and Asset Management Association, the EuroSIF, the United Nations Principle for Responsible Investments, the Global Sustainable Investment Alliance, and the Association of the Luxembourg Fund Industry. The 5 classification systems appear to be coherent and identify in total 7 SRI strategies. GSEI and EuroSIF use almost identical categorizations. ALFI gives priority to ESG component in the investment process. This method separates SRI into ESG cross-sectoral, ESG environment, ESG social, ESG governance, and ethics cross-sectoral. The PRI classification system lacks impact investing. And the IFAMA separates SRI strategies into two groups. The first is based on screening and includes exclusion, best-in-class, thematic approach, and norms-based approach. The second group is based on active ownership and includes engagement and voting. Sustainable investment strategies restrict investment opportunities. This typically worsens the risk-return profile of an investment because the a priori selection of permissible investment results in portfolios that bear concentration risk and are more exposed to unsystematic risk. However, corporate profits can also depend on risks that were previously disregarded in financial analysis, such as climate risks. By helping to make previously neglected risks more visible, sustainability analysis and criteria can enable investors to make financially successful decisions. Against this backdrop, even investors with a primary focus on generating value are increasingly considering ESG criteria. But what is the hard evidence? Do sustainable businesses actually offer higher returns for investors? A study conducted for asset manager Fidelity tracked the performance of a range of ESG investments worldwide between 1970 and 2014. They found that half of them outperformed the market. Only 11% showed negative performance. In analysis conducted by BlackRock, the world's biggest asset management company, found that during the height of the COVID-19 pandemic in 2020, more than 8 out of 10 sustainable investment funds performed better than share portfolios not based on ESG criteria. Stock exchanges and derivative exchanges affect sustainability in their markets through their influence on corporate ESG behavior and through the promotion of sustainable financial products. Derivatives exchanges can contribute through sustainability-aligned derivatives products, ESG data products, and enhanced transparency. Stock exchanges contribute through a wider set of mechanisms. The number of stock exchanges with written guidance for issuers on ESG disclosure rules has grown rapidly from 13 in 2015 to 56 in 2020. This upward trend is expected to continue as investors' interest in ESG-themed products is strong and growing. Public policies to promote sustainable development are strengthened in several jurisdictions, and more stock exchanges recognize the important role that they can play in promoting investment in sustainable development. But why do ESG-friendly investments do better than conventional investments? One factor is changing customer attitudes. A study in the US found that 2/3 of consumers of all ages prefer to buy from companies that share their values. Among millennials, people aged between 18 and 34, that figure rises to 83%. Consumers are 4 to 6 times more likely to buy from a brand with a corporate purpose they endorse, according to a global survey. But if a company does something they disagree with, 3/4 say they stop buying from that brand and encourage others to do the same. Carbon-intensive industries such as coal, oil, and gas are also finding it harder and more expensive to raise capital as leading lenders refuse to do business with them. In contrast, sustainable companies are more likely to win contracts, save costs by using fewer resources, and have less regulation, as well as retain the best people and avoid losing money on old carbon-intensive processes, according to research by McKinsey. Global companies took in a record of $859 billion in sustainable investments in 2021. Reuters reported this includes $481.8 billion in green bonds that raised money for a specific environmental project. And the level of sustainable finance is only set to grow. The total value of ESG investments is on track to exceed $53 trillion by 2025, accounting for more than 1/3 of all global investments, according to analysis by Bloomberg. Congratulations! You have made it through the first module. Well done! Since you have completed this lecture, you should now be able to outline the goals of sustainable investing, describe the most important investment strategies, discuss the sustainable market development, and explain the trends in sustainable investing. In the last chapter, we tackled various questions. What is sustainable investing? What are the strategies associated with investing sustainably? How are those strategies applied, and what can sustainable investing actually accomplish? You are now well prepared for the coming module, which will make you a specialist in explaining and applying sustainable investment strategies.